Hey you all, welcome back to Lem's Cryptoverse. So today I'm going to talk about predictions for 2023 on capital markets, and you only need to know a few things to predict everything. That's number one. Number two, I'm going to talk about my mistake of 2022. So let's get started. First of all, let me just minimize myself a little bit here. I never liked predictions, and I thought they were kind of arrogant. And this guy here, Scott Galloway, I thought it was so obnoxious and arrogant of him to make predictions. Then I started listening to him. And started realizing, you know what? Making predictions isn't just about saying, hey, look at me, and making your ego feel good. It's not about that. It's about making a framework and correcting the framework on the fly. And then when you correct the framework on the fly, you can make better decisions going forward, and you can basically predict better because you're basically adjusting constantly. It doesn't have to be constantly like every day. It could even be quarterly. So here's my prediction, and I do this every quarter. There's a prediction for 2023. And where I went wrong was number one. Actually, it's only one thing. I got the timing way off. So basically, I'm keeping my predictions that I had all year round. My biggest mistake was timing. I thought everything would happen a lot quicker. So then I drilled down. Why did I make that mistake? Because I hope this doesn't sound too arrogant, but I don't make too many mistakes when I do my research. And I'm the kind of person that I don't have conviction. I don't do a good job. I make a lot of mistakes if I don't spend a lot of time doing research. A lot of time means a minimum of 20 to 40 hours looking at one industry, one sector, looking at macroeconomic data, looking at geopolitics, looking at interest rates, gold, silver, things like that. Crypto, you got to spend a lot of time. Actually, in crypto, I spent I don't know how many hours, 1,000 hours. You got to put in your time. I didn't spend any time looking into the timing of things. And then after I made the mistake, I did some research and I realized, wow, I really was way off, because the research and empirical evidence based on past bear markets is that things take a lot of time to play out. For example, everyone is hoping for a pivot, but even when the Fed pivots, the stock market does not bottom to about a year later, at least 6 months to a year. And I didn't realize I had forgotten that. So that's why you need to do your research. So let's go over the predictions for 2023. Number one, I predicted, and I'm still predicting, that stocks would decline 50%. That's basically the S&P or the NASDAQ, 50% from their all-time high. And I became more, what's the word I should say, more confident about that after hearing Powell's comments on June 22nd of 2022. And he continued to make the same comment, which is he ain't stopping until there's a continuous data showing that inflation is going to be 2%. If he's really looking for that, even 3%, we're going to have a hard landing. Now, a lot of people are not looking for hard landing. I am looking for hard landing in the economy. I should have written that down. I did not. But that's part of my 2023 prediction and conviction, is that we get a hard landing. Number two, and related to that, I think we're going to get a steeply inverted yield curve. So we're going to get a lot of inversion in the yield curve. And not just the 2 10s, but also the 30-year versus the 2-year, and the 30-year and the 10-year versus the 3-month. So I'm writing here that the 30-year rate may actually decline below 3%. So what I think is going to happen is that the 2-year rate may go up, or the 3-month rate may go up, but the 30-year rate may stay the same or go lower. I'm thinking go lower. And I'm going to show you an Excel spreadsheet in a moment. So I think, and related to that, I think, see, notice how everything's related. I think the federal funds rate is going to continue going higher, but it's going to be less high than other people think. A lot of people think it's going to be above 5%, 5.5%. I'm looking for a terminal rate, or the top of the Fed funds rate, no higher than 5%. And precious metals, I think I've been thinking this for a year now, that gold's going to bottom at 1500. That's going to leave that placeholder there. And a place to watch for a turning point is a commitment of traders. That's why I mentioned positioning right here. And then lastly, I think Bitcoin is going to go down to maybe 13,000. No, maybe downside case lower. And I'm basing this on a lot of research I did based on production cost, miners, because I think miners are like fracking, oil frackers. I think they're going to spend all their debt financing on the latest, greatest rigs, and they're just going to push the industry to bankruptcy. And I'm going to know when they hit bottom, when a hash rate goes down, when a difficulty rate goes down, and when the exahash amount continues to stay low. And you could look those up on your own. Difficulty rate, hash rate, and exahash. And you can also look at the pure multiple too. These need to go lower. And I promised you I would show you some interest rates. But before I do that, I want to show you something that people do that we need to improve on if we want to be better predictors. Most people, like myself, we watch the news, or we read the newspaper, we go on Twitter, and we see the news, and we're like, oh my God, there might be a nuclear war, and then we forget about it. They say, oh my God, valuations are high, and then we forget about it. They say, oh my God, 3AC Capital went bust. Can anything else go bust? Then we forgot about it. So that's what you need to write everything down. You could see I wrote all the big tail events that could happen, or black swan events, such as the Ukraine war and supply issues, slowing global GDP growth, risk of a nuclear war. And I think these risks are high. I think the risk of a nuclear war in Ukraine is higher than 30%. I think it could actually be probability of 50%. These could be smaller tactical nuclear weapons, but I still think the risk is very high. I still think there's a risk of another black swan event in crypto, as well as overall hedge fund, even pension funds, because pension funds are losing out both on treasuries and corporate bonds and stocks. Remember, these pension funds, they put a lot of money into treasuries and stocks, and these can go much lower. These have been much lower. Usually treasuries do well and they go up when stocks go down. This did not happen this year, and that's one of the few times in history that's happened where pension funds have nowhere to hide. And so there could be a crisis there. And the list goes on and on. You could see I wrote it down here. But I promised you I would show you interest rates. And let me open up that file. Now here I have the yield spread, and you can see, and this is read from right to left. So you got this 3-month, 6-month shorter rates on the right, and on the left side you have the longer term rates. And you could see in orange, and this is I think this was in July, basically. Yeah, this is in July. I could see it here. Yeah, that was July. You could see it lighting up here. So basically, I'll make it larger for you. You could see we had a flat yield curve, and now it's much steeper. You could see the let's start from the 1 year. The 6 months is the same. You could see the rate for shorter term treasuries is much higher now than it is for the 30-year bond and the 10-year note. So that's a really steep yield curve. Here, where you see here is flat. In orange and the blue, it's much steeper. And then you could see the actual yield spread right here. You could see where I don't have, you cannot see the date. The date's up here. You know what? Let me hide these. I could just hide them right like that. And now you could see the evolution. So for example, in July 14th of 2022, the 10-2 was only 15 basis points negative, and the 30-year versus the 2-year was flat. It was 0. But by December 16th, it was minus 66 basis points. So that's pretty interesting. Let me unhide that now. And so where did we have, when did rates, long-term rates, go down quickly? And I did some research, and it happened around November, between November 10th and November 16th, there was a large decrease in long-term rates, and that's what you're looking at here. Right here, where I've highlighted in orange and in blue, that's the 30-year rate and the 10-year rate. And you can see they went down quickly, much quicker than these shorter term rates. So this is the 1 year treasury bill, and this one here is you can see it light up here. It should show up. That's the 1 year bill. So these are shorter term rates. So they've been flattish. But if you look at the 30-year and a 10-year rate on the bottom here, these rates have gone down quickly. And that's because of lower inflation. That was the number one factor. Lower PPI and a lower CPI. So that's all, folks. I hope you enjoyed this. And I hope you can see that you need to have a framework of where the market's going. And all markets, because all markets are connected. And that's number one thing. And number two, I think we have a lot more damage to go. Even though the stock market's been going up quickly, I still think it could go up higher vis-a-vis a Santa Claus rally. I think in the next few months we can go down sharply in stocks and in crypto. So just be careful out there. Thank you for listening, and don't forget to like us. Bye-bye.